What's up, stock compounders? Brad here. Today I want to talk about the challenge of learning from mistakes in investing. Okay, this is something I've been thinking a lot about recently. There was I think I was in the comments section on Financial Education Jeremy, and he was talking about buying Tesla. I think he bought it around $230 per share. It's north of 1,500 now. And he was talking about, all the haters that came onto his comments. And we're talking about how ridiculous of an idea it was to buy into Tesla at $230 per share. And Financial Education Jeremy basically said, I was right. Okay. He was right because he bought in at 230 and now the stock is in the 1500s. And, part of the challenge of learning from mistakes in investing is that investing is really a probabilistic activity, okay? Just because someone buys a stock at 230 and it goes up to 1500 does not mean that that was right from an investment perspective. And you might be listening to this and thinking, what is this guy talking about? Of course, that was the right decision. But when you look at investing as a set of probabilities, okay, there's, say, a 5% chance that this investment outcome is going to be dramatically positive, say 5 to 10x. Maybe there's a 20% chance that it's slightly positive. You've got a probability that it's slightly negative. You've got a probability that you lose a lot or even all of your money. So, the outcomes, it's never 100% certain in investing because we're really dealing with the future and, nothing is certain about the future. So, I left him a comment. I said something like, yeah, it's great that investment worked out for you. But it doesn't necessarily mean you were right. There could have been a 5% probability that Tesla would be doing as well as it is today. And some outcome had to happen. That's how the world works. There's going to be some outcome that happens. And, we don't know how much of it is luck and how much of it is skill, right? Hitting that kind of 5% bucket. There's luck involved in that. Obviously, with skill, there's, the more you understand a business, not just the business that you're investing in, but all of the kind of businesses that feed into that and the businesses that are served by that company. It's really a, dynamic ecosystem. Business. And so, there's a lot to understand. There's a lot to wrap your mind around. At one point, Monish Pabrai was talking about why he's been successful as an investor. And he was talking about how, his dad was a serial entrepreneur. And so growing up, he witnessed, all of these businesses constantly started by his dad, and then they would flourish, and then inevitably something would happen and they would fail, and his dad would have to kind of pick himself up by the bootstraps and start all over again. And so, Monish, he got to see so many different business models and really understand kind of the mindset of what it takes to be an entrepreneur from a very young age. And he says because he was exposed to all that at a very early age, he has a huge advantage in terms of understanding businesses versus people who didn't get that entrepreneurial business exposure when they were young, when they were in their teens, even before teens. So that's huge, getting that kind of entrepreneur experience from a very early age. But anyway, I also want to talk here what I learned in school versus investing. So I'm an engineer by training, mechanical engineer. I went to the University of Wisconsin at Madison. And the thing I learned taking tests, taking quizzes, is that there's a right answer, okay? And if you can kind of break down the variables that are known in the question, and you know the formula, right? The formula that combines those variables that you're given with a variable that you're looking for, the variable that's the answer. If you have those things, you can get the right answer. And what that taught me is that there's a right answer, right? And usually there's kind of one way to find it. If you don't have the key, if you don't have the formula, you're not going to get to the right answer. So that's really what I learned in school. And guys, that is not how investing works, okay? And that's partly why it's hard for so many people, is because what we learned about kind of figuring out the right answer growing up is very different in investing. It's really, probabilities. There's no right answer. There's investments where you can have a high probability of a lot of upside. You can have this asymmetric risk-reward profile that value investors typically look for, where half the time you're going to get a 5x, and the other half the time maybe you'll lose 10 or 20%. That's a great opportunity for a value investor. But there's no right answer. Even if you bet on something that's 99% certain, right? It's like the most obvious investment decision you've ever made. There's still that chance that it's going to go south. Graphtech comes to mind, and how, they have 3 to 5 years of contracts locked in, right? They're locked in. And Monish invests in Graphtech because the income from the earnings from those locked-in contracts, are going to give him his money back in 5 years. And of course, we enter this pandemic, and these contracts are no longer a sure thing. Companies are declaring bankruptcy, they have to void the contracts, and so, it just goes to show you, it's a reminder that investing is a probabilistic activity. Another huge issue, there's a benefit to this, and there's also a negative. The benefit with patience. So the biggest advantage we have as investors is if we are looking at investment opportunities as owning a piece of that business. And what that means is we're in it for the long term. We're looking for the business to kind of transfer those gains to us over time. We're going to benefit from the success of the business by being a part owner. That's kind of an owner long-term mentality of a business. If you're in it for the short term, you're playing the price game, okay? You're getting in because you think the price is going to go up by a lot in the next couple months or a year, which doesn't necessarily have anything to do with what the business is doing. It's, looking at kind of short-term trading factors, technical analysis, that kind of stuff. But so you have this advantage of patience, right? Of this kind of long-term buy and hold mindset. But there's a downside to that. And the downside is it can take years to realize that you made a mistake, right? And to actually learn from that mistake. If you're a value investor who has a concentrated portfolio, the feedback loop for making mistakes is very long. It's very slow to kind of learn to realize that you've made a mistake, and then to learn from that mistake can take years or even longer. So that's a problem for investors. It makes it hard to get better at investing. If you're taking few swings, if you're only buying maybe a stock or two every year as a concentrated value investor, and you plan to hold for 5 to 10 years, the lessons are going to be slow to come in. The lessons from the mistakes. Really, the solution to that is to learn from other people's mistakes. And that was an awesome thing that Pabrai mentioned in one of his lectures back in 2008. His fund was down massively. I think it was down one of his funds was down 70%. Okay, and what he did is he hired some interns. Apparently he still had enough money to pay for some interns, but he hired interns to study the mistakes of great value investors, right? So they would comb through all of the buy and sell decisions. So what did these great investors hold? Did they sell at a loss? Okay, and so we're looking at all of those investments where these great investors lost money. And then the big question was, can we go back to when that investor bought that position? And is there anything that we could have seen that was a red flag for, before making that purchase, that might have indicated that it would end up as a loss? And so Pabrai, he found a number of patterns. The biggest one is using leverage, right? So most of the companies that lost money for these great investors, they were levered companies. They were using too much debt to finance growth of the business. So that was the biggest one. And so Pabrai, he incorporated these mistakes that he discovered that other investors had made into his checklist. So when he finds an investment opportunity that he thinks he wants to act on, he's got this checklist of dozens of questions that help him kind of look at everything in terms of not missing any obvious red flag. Okay, it helps him thoroughly, inspect all of the aspects of the business, of the potential investment, just to make sure he's not missing anything. And that's learning from other people's mistakes. I mean, it's really the easiest way to get ahead in investing, because there's such a slow feedback loop, and because we can see what other investors have bought and sold through 13F filings. There's a lot of documentation in terms of mistakes that great investors have made. Obviously, investing is a very data-rich sphere, so it's easy to kind of go back and look at income statements, balance sheets, when that initial investment was made, and try to figure out, okay, this investor should have seen this issue, and that should have prevented them from making the investment. So that's the problem. The problem is it's a slow activity, and it takes a long time to recognize and then learn from mistakes. And the solution is to learn from other people's mistakes. Now, the same way, if your investment works out wonderfully, that doesn't mean you were right. If you make an investment and it works out poorly, that doesn't mean you were wrong. So that's another thing that makes it difficult to learn from mistakes, is that it's hard to know what the probabilities were of that investment working out versus not working out, and whether or not you were on the right end of those probabilities when you made the investment, because that's really the important thing. We can't control if you get these outcomes that happen in the kind of unlikely band of probabilities. That's not a mistake we can really learn from. That's just probabilities. That's just, 1 out of 10 times it's not going to work out, or whatever the probability is. So don't mistake winners as you were right. Don't mistake losers as you were wrong. It's more complicated than that. Okay. The best we can do as value investors is strive to understand as fully as possible the business that we're investing in. And with that understanding, we can gauge probabilities of various outcomes. And I really like the videos that Aswath Damodaran puts out. He's a business valuation professor at NYU. And he does videos where he values companies. And when he does these valuations, he comes up with a number, but he also comes up with a probability distribution for kind of what the likelihood is that, the company will end up in kind of the bottom 10% tier of the valuation versus 50% versus the 90% tier. And I think that's an incredibly valuable exercise to think about, what is that probability distribution? Is it skewed more to the upside? Is it skewed more to the downside? Just to go through that exercise, I think is fantastic. So I will leave you guys with that. Stay safe out there, and let me know what you've learned from mistakes that you've made recently, maybe from this year in your investing endeavors. All right, guys, I'll see you in the next video. Take care.